Yesterday, we announced our decision to maintain the policy rate unchanged at 0.5% per annum. This decision is effective today, the 20th of February 2020. My team of deputy governors who are here with me are happy to answer any questions you may have about yesterday's interest rate announcement and any questions you may have too about the quarterly monetary policy report. But before I do that, let me provide some insight into what influenced our decision yesterday. Our decision to hold the policy rate unchanged is based on our assessment that monetary conditions continue to be generally appropriate to support inflation remaining within the bank's target of 4 to 6% over the next 8 quarters. Recall that the bank's inflation target was set by the government to facilitate a faster pace of economic growth while at the same time supporting the country's ongoing debt reduction strategy. I believe we are now seeing stronger signs that the bank's accommodative monetary policy has been bearing fruits. As you know, the bank has reduced the policy rate from 3.25% at the start of 2018 to the current level of 0.5%. In response, we have seen that the deposit-taking institutions, that is, commercial banks, merchant banks, and building societies, have recorded strong growth in loans as well as marked reductions in lending rates on local currency loans. In particular, credit extended by DTIs to businesses grew by 20.3% for the 12 months to December 2019, while credit provided to households grew by 16.5%. This growth was notably faster than the expansions of 15.4% and 12% in credit to businesses and households respectively, which was recorded in 2018. In addition to the loans from DTIs, it is encouraging that a number of firms are obtaining financing from the issue of corporate bonds and equity. This buoyancy in credit growth has not been reflected in the headline GDP growth numbers, partly because of the recent fallout in mining and agriculture. However, non-mining GDP, which abstracts from the difficulties experienced in the mining sector, is trended upwards from 1.1% for September 2018 to 1.4% for the September 2019 quarter. This acceleration is being buoyed by marked increases in tourism and manufacturing. Additionally, an important leading indicator of economic activity, GCT tax inflows, suggest continued economic expansion. Nonetheless, the economic expansion remains below the country's capacity, and it is largely for this reason that we believe inflation will average slightly below 5% over the next 8 quarters, and why we have kept the accommodative monetary policy in place. Let me now provide some more details on inflation. In Statin's latest release, prices faced by consumers in Jamaica, on average, rose by 5.2% for the year leading up to January 2020. This outturn represents a reduction from the 6.2% recorded at December 19 and reflects a return of inflation to the target range. You will recall we had previously indicated that inflation spike in December 2019 was temporary. This slower pace of inflation in January 2020 was mainly reflected of the impact of lower electricity rates, some reversals in agricultural food prices, as well as lower costs for petrol and air travel. Of note, price increases that exclude the influence of agriculture, food, and fuel prices, otherwise known as core or underlying inflation, remained low, just a little above 3% for the year to January 2020. Some moderation in the rate of increase in agricultural food prices is expected in February, but we anticipate that headline inflation will be high for the month due to a temporary spike in electricity rates. Looking further ahead, Bank of Jamaica expects that the annual rate of consumer price increases will average about 4.7% over the next 8 quarters. This outlook for inflation is based on the stimulating effects of Bank of Jamaica's past monetary accommodation on prices, as well as imported inflation. The impact on inflation of these developments is expected to be partially offset by continued tight fiscal policies. I invite you to read the QMPR for additional details about the inflation forecast. I'm sure you're aware there are emerging risks within the global and domestic economy that could have an implication for prices here in Jamaica, largely stemming from both weather-related concerns and global health epidemics. In particular, the effects of extreme weather conditions in Jamaica could result in increased volatility in agricultural prices. High inflation could also arise from imported inflation if global growth is stronger than anticipated in the context of easing international trade conditions between the USA and China. On the other hand, the continued spread of the novel coronavirus mainly poses a downside risk to inflation, as international oil prices would likely decline and global and domestic growth could be lower than expected. Before we open the floor to take your questions, allow me a few minutes to provide you with a brief update on recent developments in the foreign exchange market. For the calendar year to 19th of February 2020, the Jamaican dollar has depreciated by 6.4% or $8.48 to close at $141.05 to the US dollar. We wish to observe that the demand for and supply of foreign exchange in the market is generally in balance, save and except for periodic bouts of extraordinary demand. The recent depreciating trend was mainly influenced by, one, bouts of large block demands associated with capital market or portfolio transactions, end user demand associated with post-Christmas restocking, and authorized dealers increasing their net purchases of foreign currency in the market, having net sold in December. The post-Christmas demand has been settled, and further, dealers are now selling more to the market than what they buy. However, there remain some capital market transactions. We note the exchange rate has been appreciating over the past 4 days, a continuation of the two-way movement in the rate. In the context of the increased volatility in the exchange market, on the 22nd of January 2020, the BOJ introduced the foreign exchange swap arrangement, a new instrument intended to enhance the bank's management of the foreign exchange market and provide US dollar liquidity to the system through authorized dealers. The bank believes that along with the usual BFIXit operations, the FX swap arrangement will be a useful tool to smooth out excess volatility and restore orderly conditions in the market. Additionally, the Bank of Jamaica is well advanced in rolling out a real-time trading platform for foreign currency. With these initiatives, I want to stress that the onus is on the stakeholders, that is, suppliers of foreign exchange, users of foreign exchange, authorized dealers, and cambios, to ensure that the market functions efficiently and smoothly. The liberalization of Jamaica's foreign exchange market is essential to our economic development, but the benefits of this regime can only be realized if the private sector participants, that is, banks and end users, manage the market in a responsible way, particularly with respect to capital market transactions. BOJ has been in constant consultations with the dealers and other participants in the market and will continue this dialogue with the aim of ensuring that the market improves the way it operates. Ladies and gentlemen, in closing, the prospects for the Jamaican economy continue to be generally positive. Foreign reserves are at adequate levels, and we have been achieving the government's targets for non-borrowed reserves. We have a sustainable current account of the balance of payments. Fiscal performance is strong. Public sector debt continues to decline at a steady pace in line with the fiscal responsibility law, and our credit ratings have been upgraded. Jamaica's unemployment rate continues to improve. Our employment rate, I should say, continues to improve, and market interest rates remain generally low. We continue to assess that the economy could grow at a faster pace without resulting in inflation increasing above the bank's target. In this context, Bank of Jamaica has maintained its policy rate at 0.5%, but will closely monitor the impact this has on credit expansion, capital market transactions, overall economic activity, and consequently inflation, to determine the appropriate future path of the policy. Thank you, ladies and gentlemen.